So the reverse repos are done. There's practically no more of them. I think the last one was like 3 billion, which is basically nothing. So the quantitative tightening, the QT, the shrinking of the balance sheet that the Fed has engaged in since it started at the peak of the balance sheet was sometime in 2021 for the last 4 years, maybe 2022. I don't remember. It's all blurring together. All this COVID and the printing and AI, it's all kind of like mushing together in my head. Whatever's happening in the world. So since the Fed started QT, they've been shrinking effectively the reverse repo amount, which is money that's outside of the banking system, and now it's no more. So all the QT it has been draining bank reserves, and bank reserves are used as the grease, as the slime that coats the repo market. That's the money that's being traded. Those are the dollars that are being traded every night, 3 trillion of them, the bank reserves. Now, I had a theory which ultimately proved wrong. I don't think it's in principle wrong. I just think that I missed a technical aspect that I suspected I might have missed, but I didn't really take it seriously. I thought that the amount of reserves could not be less than the amount of repos that are traded every night because they're trading the reserves. So it turns out they can. I just don't know by how much. I don't think by that much. So right now the ratio the bank reserves are falling. They're now at like 2.9888 trillion, like below 3 trillion, and this week's number, which should be out in a few hours, and in 2.5 hours it'll be out and I'll check it, it should be like something like $80 billion less, because the government shutdown, right? It means that the government isn't spending as much money. It's spending, I think, on mandatory spending, but not on discretionary or something like that. I don't know exactly what the technical details are, but it's spending less money than it otherwise would. So all the money that's sucking out of the bank system is not being spat back into it. So they're raising money. I think the total dollar cash hoard that they have is like $930 something billion. It was whatever it was like 60 or 70 billion dollars more than it was last week. So that's money that's taken from reserves. So yeah, now you have 2.988 trillion minus about 70 billion, so it's like 2.91 trillion or something, and the amount of repos that are being traded is over $3 trillion. It's like 2.98. It fluctuates between like 2.95 trillion and 3.0 or 3.1 trillion, something like that. Like how much longer can this go on? I mean, we're looking at the repo rate. It's called the SOFR rate, and it keeps wobbling. It wobbled again 2 days ago, up 7 basis points, and now it was down 3, and tomorrow could be up 10. Who knows? If it's already wobbly, that means things are already tight. And the standing repo facility that the Fed instituted after COVID, it provides emergency repo money to banks that can't get it because maybe the reserves run out. It's being used. And sparingly, like a few $1 billion a night, but it is being used now. It wasn't being used before. So we know that some banks are out of reserves, so they can't get any. So there is a shortage here. It's going to get worse as repo trading keeps expanding, as it does, because you have all these hedge funds that are, I don't know, trying to pick up pennies with basis trades. I don't even want to go into the technicals of that. It's just you're trading around dead zombie money and earning a few pennies on levering it up like 50 times each night. So this is going to end. And it's going to end soon because the repo rate is already moving several basis points a night. It's already tight. If you read these books on hyperinflations, isolated hyperinflations in the world, I remember reading once, maybe it was When Money Dies, I forgot who the author was, but it was about Weimar, and he was talking about during the late 1923 when the hyperinflation was in full swing. You had government agents of the Weimar Republic just like raiding people and stealing whatever hard money they had on them to try to get ahead of the hyperinflation, where they had gold coins in their pockets or silver coins, and they even outlawed platinum because some people were hoarding platinum and using platinum for exchange because they couldn't use the stupid paper mark. Even back in 1923, platinum was still being hoarded as some kind of a money, as some better money than paper money. So the reason platinum would be disjointed, not necessarily because there's a sudden demand for catalytic converters or whatever, is platinum is used for primarily, and that's primarily catalytic converters in cars and other strange niche kind of things that I really have no understanding of. I don't understand car parts or anything like that. But since it is a pseudo money and the liquidity is so low, people could think, well, gold's too expensive. It's like $4,400 an ounce. I mean, there's probably a little bit of a physical premium on it. To get an ounce would probably be $4,400 today, despite the fall. and they might get some silver, but they might also want something that's more value dense just to preserve their wealth, and they don't want gold, and they think the platinum's really cheap because they think of the 90s and like, okay, well, platinum was much more expensive in the 90s than gold was. That's why like the platinum credit card is considered a higher line of credit than the gold credit card, that's left over from that decade. So in their mind, platinum could be more valuable. And as markets shift from industrial to monetary, industrial demand is demanded by the creators of whatever piece of capital equipment they're producing for industry, right? Or consumer good. But monetary demand is by definition everyone. So even the slim amount of monetary demand would be more than the very specialized industrial demand for platinum. If you have even a tiny percentage of monetary wake up of people looking for a preservation of value, and they don't want gold because it's too expensive, then they'll see platinum is cheaper, so want to take that. Maybe they'll go for it, and that could overwhelm the very, very thin platinum market, as it's overwhelming the silver market, which is why you're seeing all this disjointing through London and New York. What that means, just very broadly, in a broad brush strokes, is that the monetary demand for silver is starting to wake up, and the silver market is not structured for that. It's structured for silver as a commodity, and it doesn't have the capacity to satisfy the demands of people who are demanding silver suddenly as money because they're panicking.
Let's take a deep breath and look at
Let's take a deep breath and examine where we honestly stand in this monetary performance. Because right now, everyone's sprinting around as if it's already the concluding scene. It's not. We haven't even reached the genuine fireworks yet. The next currency creation cycle hasn't begun. The reverse repo mechanism, the Fed's convenient outlet for surplus liquidity, is nearly drained. The most recent figure I noticed was roughly $3 billion, which is essentially insignificant in a financial system that consumes trillions before breakfast. That piggy bank is finished, but the Fed hasn't yet ended quantitative tightening. They're still reducing the balance sheet, though more gradually. Rates remain elevated. The Fed isn't acquiring bonds on net, and we haven't reached the point where they slash rates to zero and go into full crisis mode. In other words, we're not yet at the section of the film where the protagonist leaps into the vault and hits the giant red button that saturates the system with cash. That's what makes this instant so extraordinary. Gold has already advanced so much, so quickly, without the printers roaring. It's as if the market is front-running the upcoming emergency. You'd assume gold would require a clear round of QE to surge. But here it is, shattering records before the next phase has even commenced. That reveals something significant about confidence, or the lack thereof. The worldwide financial structure is already preparing for the tempest. But don't lose control. Gold won't simply ascend every single day until the Fed capitulates. We're still in the break between acts. Right now, the dollar is still in what I like to call a perpetual short squeeze. There's always more dollar-linked debt in existence than there are actual dollars to settle it. That's the character of a debt-based arrangement. Every dollar is issued as debt, which means the total debt burden always surpasses the money pool. So, when defaults initiate or when liquidity tightens, it's like a worldwide game of musical chairs. Everyone rushes for the remaining dollars, and the music intensifies until someone collapses. And when that occurs, gold and silver don't escape unharmed. They decline too, just like everything else. Stocks, bonds, even Bitcoin. It's not because they failed as secure havens. It's because in a liquidity crunch, individuals liquidate what they can, not what they prefer to. Gold dropped in March 2020, right in the middle of the pandemic turmoil, falling to around $1,450 before roaring back aggressively. The mining equities were devastated, down 30, 40, even 50% in a handful of trading days. Everyone shouted deflation, but that was only the warm-up. Then arrived the genuine event, the currency tidal wave. The Fed created trillions out of nothing, cut rates to zero, and began acquiring everything from treasuries to corporate bonds. And gold and silver behaved exactly as they always have. When a money printer starts buzzing, they skyrocketed higher. Day after day, week after week, limit up, no pullbacks. You can set your clock by it. That's the cycle we'll witness again. Only this time, it'll be amplified by the enormous scale of the debt balloon. But here's the critical point. We're not there yet. We're still in the tightening stage. The dollar short squeeze is ongoing. The banking structure is beginning to wheeze, but the Fed hasn't panicked yet. When it does, when the defaults appear and liquidity freezes, that's when we'll witness the next round of printing. Until then, there will be retracements, head fakes, and plenty of commotion. Now, let's peek beneath the surface at what's happening in the plumbing of the structure. The bank reserves, the lifeblood of the repo arena, have dropped below $3 trillion. They were around $2.98 trillion last week, maybe 70 or 80 billion less this week due to the government shutdown. Why does that matter? Because these reserves are the lubricant that keeps the overnight lending markets functioning. Banks exchange these reserves with each other every night in the repo arena.
The engine starts to seize up.
I think the most important point here is to take a step back and to realize that we are not yet in the final sprint to the end game because the next printing round hasn't even started yet. Right? The reverse repo extra money bank has been depleted, but the Fed hasn't stopped QT, hasn't stopped shrinking its balance sheet. It's slowed it down, but it hasn't stopped it. It hasn't cut rates to zero, and it hasn't started buying bonds net yet. It just, nothing is happening. And the fact that gold has gone so far so fast before the next printing round has even started kind of surprised me. So my point is that gold is not going to go up and up and up and up every single day until the next printing round starts. I mean, just like it was in COVID, you know, the Fed cutting to zero immediately because there's a bank scare, or JP Morgan says they have to. Whatever it is, the big banks come together and say, Fed, we need you to move. And then they print twice, 3 times, 4 times as much money as they did during COVID. Then gold and silver should go up and up and up day after day after day without any kind of pullback at all. But we're not there yet. So until we are there, the dollar is going to be in a perpetual short squeeze, meaning there's always more debt than dollars exist. So at the point when somebody starts defaulting, then you have, it's like a game musical chairs where the music stops and everybody's got to sit down, and whoever sits down last doesn't get a chair. So when the music stops and the defaults start, that's when there's a rush for dollars, and there's going to be a big rush for dollars at some point, and gold and silver are going to sell off just like everything else. It's just that gold is going to sell off less than everything else, just like it did in COVID. Gold sold off during the lockdowns. It did, and it reached a low of 1450, and the miners got clobbered. I don't know, 20, 30, 40% in a few days. I don't know if it's going to be that magnitude this time. It's going to be the same kind of thing. And then the Fed's going to reinflate. And then at that point, we can say we're in the final sprint. It's going to take a few weeks until the dollar collapses. But we're not there. We got to wait for that to happen. And meanwhile, we can play the game of, well, what was the proximate cause that made gold and silver fall down specifically on October, whatever it was, 21st. And then we could look at the movements in the market. But that's all inevitable. It's always the same story. There's going to be something that is going to cause a correction until the Fed reinflates. So wait for that to happen, and then you can say that there's going to be no more corrections. But until then, you got to stay balanced. We can't be too euphoric, and we can't be too discouraged, because we're still in a dollar short squeeze where there's more debt than dollars that exist, and that's what's going to happen.
We saw a little bit about performance on that last leg by silver, but really gold and silver moved together for the most part. So that signals that we aren't at a blow-off top stage. Can you share a little bit about this, the gold-silver ratio, and what that signals to where we are in the bull market?
Yeah, you can come up with 1,000 reasons why it happens. But before we go into the reasons why, we just have to remember that this is what has happened every time since 1918. Since the end of World War I, which was the end of a huge inflation that funded the Great War back then. And then at the end of that inflation, silver outperformed gold until a silver dollar was worth more than a gold dollar. Not that silver was worth more than gold, but if you had a silver dollar coin versus a gold dollar coin.
So what occurs next? The initial indications will be noticeable in the repo arena. We'll watch instability surge, funding gaps stretch, and the software rates start acting unpredictably. The Fed will pretend everything's stable, then discreetly step in with temporary liquidity additions. They'll insist it's technical. It's always technical until it isn't. Once the strain increases enough, maybe a bank collapse, maybe a bond arena freeze, they'll have no alternative but to change direction. Quantitative tightening will stop. Quantitative easing will return. But this round, it won't be restricted to treasuries or mortgage-backed securities. It'll be everything: corporate bonds, municipal obligations, maybe even equities. They'll saturate the globe with dollars to stop the dollar from collapsing under its own scarcity. And ironically, that's when the dollar actually begins dying, not from strength but from overload. When that unfolds, gold won't simply climb, it'll go vertical. Silver will trail. And then platinum, the overlooked metal, will unexpectedly transform into the new currency for those priced out of gold. Picture ordinary investors looking at gold at $4,400 an ounce, thinking, that's too pricey. I'll purchase silver at $75 or platinum at $1,200. That shift in viewpoint will send shockwaves across these tiny arenas. Here's what people forget. The monetary metals arena is microscopic compared to worldwide capital. All the gold ever mined is valued around $15 trillion at today's levels. All the silver above ground, maybe $1.5 trillion. The platinum arena? Barely a rounding error. If even 1% of global financial assets decide to move into hard money, you'd witness price multiples, not percentages. That's the arrangement. Meanwhile, the banking apparatus is already trembling. You can observe in the numbers if you know where to look. The Fed's balance sheet has reduced, yes, but at the cost of draining the very reserves that lubricate the financial framework. The Treasury's general account, the government's checking account at the Fed, is inflating again because Congress can't stop spending. That's pulling liquidity out of the banks. You can view it like this. Every dollar the Treasury collects in taxes or debt issuance that doesn't get spent instantly is a dollar removed from the banking framework. Those reserves are fading, and as they vanish, the repo arena, the core of dollar funding, becomes more delicate. It's a slow-motion bank run at the institutional tier. When the crunch strikes, the Fed will intervene, as it always does, but the psychological harm will be finished. Trust is the only thing that sustains fiat, and trust is already diminishing. That's why gold is rising before the printing begins. The informed money sees what's approaching. Now, let's return to silver. The silver arena today is like a tightrope stretched between two realms, the industrial realm and the monetary realm. For decades, silver's price was ruled by industrial demand: solar panels, electronics, medical instruments. But as inflation hits and confidence in fiat disintegrates, a new buyer steps in. The saver, the citizen, the retail investor who just desires something tangible. That's why you're witnessing disorder in physical premiums, delivery holdups, and separations between paper and spot arenas. The monetary demand is awakening and the arena framework isn't prepared for it. The same thing occurred in gold in the late 1960s. Back then, the U.S. still claimed to redeem dollars for gold at $35 an ounce, but physical demand was erupting. By 1971, the framework broke. Nixon sealed the gold window and gold repriced overnight. What's occurring in silver right now is the same mechanism, just quicker and with more leverage. And recall, silver is far smaller than gold. It doesn't require much buying to push it sky high. Now, I can already hear the cynics saying, but Rafi, silver's erratic. It's manipulated. It's inconsistent. Sure, is all those things, but so is every arena in transition. When money itself is breaking, the things that symbolize real value will move violently. That's not disorder. It's price discovery. We're observing the slow expiration of financial repression. For over a decade, savers were penalized, borrowers were rewarded, and central banks pretended they could fine-tune the economy by adjusting the price of money. That fantasy is collapsing. The arena is taking control back, and it's not going to be attractive. When the Fed finally panics and reopens the spigot, it won't be a gradual climb for metals. It'll be a moonshot. You'll see gold up $200 in a day, silver up $5, $10, maybe more, and platinum tripling before most investors even realize it. And here's where things become truly intriguing. As the monetary tide shifts, the the psychology of value shifts. People stop thinking in terms of price and start thinking in terms of preservation. They stop asking, what's the yield? And start asking, what will still exist tomorrow? That's when gold becomes unreachable, silver becomes scarce, and even platinum becomes a sign of stability. Now, let's put this into historical perspective. In Weimar, Germany, as inflation spiraled uncontrollably, people hoarded gold, silver, even platinum coins. The government eventually banned them all. They even prohibited the possession of platinum because people had begun using it as underground currency. Why? Because monetary demand, once awakened, is unstoppable. Industrial demand is finite. Monetary demand is infinite. It's everyone at once realizing they've been holding promises instead of money. That's exactly what's occurring now. We're noticing early signals of that awakening, small at first but increasing. The gap between London and New York silver prices, the rising premiums, the declining physical supply. These are signs of a monetary reawakening. When the Fed finally breaks and restarts QE, that spark will become a wildfire. People will rush into metals, not merely for profit, but for survival. And a framework designed for leverage, not settlement, will freeze. The final phase will appear chaotic. Repo arenas breaking, currencies fluctuating wildly, stock arenas whipsawing, and through it all, metals climbing. Not smoothly, but relentlessly. And at that point, we'll witness something new, the reappearance of money as something tangible. Maybe not a full return to a gold standard, at least not immediately, but a psychological transformation. Gold, silver, and yes, even platinum will reclaim their roles as the basis of value. So, don't get distracted by the noise. Don't obsess over whether silver's $26 or $29 this week. That's meaningless. Focus on the tectonic shift occurring beneath the surface. The reserve framework is hollowing out. The grease that keeps the global financial engine operating is drying up. And when the engine finally freezes, you'll witness the greatest transfer of wealth in living memory, from paper holders to metal holders. That's the conclusion. It hasn't started yet, but it's advancing rapidly. Stay updated on the newest events shaping the precious metals arenas with regular insights from the Finance Daily crew. Not only that, but as a subscriber, you'll also receive prompt silver and gold price alerts and early access to groundbreaking updates unavailable to the general public. Join our free gold and silver newsletter today. Link in the description.